Right. So this one will cover factoring. And factoring's when the three conditions for the sale were met, that the assets were isolated from the transfer, that the person that the receivables were transferred to had the rights to sell them, and that there was no underlying repurchase condition for the seller to reclaim the receivables at a later date. So there's two ways they can be sold, and one is called without recourse and one is with recourse. So when we factor without recourse, basically we sell the receivables, but the seller has a sort of limited liability because it doesn't need to cover any receivables that are default or bad debt. So the recourse means without obligation. So the seller is under no obligation to cover the losses that result from selling receivables, and that customer who the receivable belongs to, say, declares bankruptcy. We don't have to worry about it. So there's a lot of moving parts for a factoring transaction. I want to cover them each and kind of just talk about them briefly. So we are selling our receivables. We're going to get cash. Typically, the factor will only advance 8% of the cash. That is less than 100%. So we get cash for less than 100% of the receivables we sell. And the reason why we don't get 100% is that the factor will withhold some of the initial cash outlay to be sure that the receivables we sell them are going to be collected without sales returns allowances or discounts, things like that that might alter the value of the receivable sold. So they're going to withhold some of the receivables. They will charge a factor fee on top of the entire transaction. And that's just their fee for collecting receivables on the behalf of the company and loaning money in advance for the receivables that they will have to collect over time. Now, the as I mentioned, the cash is less than 100%. The amount that is withheld is recorded as a receivable from factor by the seller, and the seller, or sorry, the factor would record a payable to seller for the amount they withhold. So, say for example, we get cash for less than 100%. So we were fronted 95% cash for selling $100,000 of receivables. So the cash we get, of course, would be 95,000, 95% of the 100,000 we sold. Now, that covers only 95 of those thousand of that whole amount, obviously. The 5,000 that is withheld is going to become this receivable from the factor. Now, one of the issues with this is that we as the seller understand that some of these that they're withholding, the 5,000, remember the reason they're withholding it is because they know that receivables will have returns and sales returns and allowances, other events like discounts that will keep them from claiming the full price of the receivables they bought. So we as the seller know that's going to happen. And we as the seller know we're not going to get back the entire 5%. And so the 5% in this case forms the basis for the receivable from factor. And I say basis because, as I mentioned, we know as the seller, we're not going to get back all 5%. So, as the seller, we have to estimate a fair value, a fair value of the amount withheld. So, we're going to say 5% withheld is $5,000, but we don't expect to receive $5,000. Sales returns and allowances will reduce it. Maybe we say the fair value is 4,000. And the fair value would take into consideration any returns and allowances and discounts. So the seller sets that fair value and records the 4,000, not the five, as the receivable from the factor. They're just giving out an expectation of what they're going to get back. And if it turns out to not be correct, we can adjust for that when the deal settles out. The factor does the same thing with a payable to seller account, where it assesses the fair value of its liability to return some of the cash that it did not advance. Right? Finally, we have a gain or loss on sell. And the gain or loss from sell, just like sort of when we sell PP&E, we have a gain or loss based on whether the sale price is greater than the book value, then we have a gain. Otherwise, if the sale price is less than the book value, then we have a loss. And I will kind of walk through a way of thinking about gains and losses and calculating them.